Welcome back, dear students and scholars. In the first two videos, we decided when ASC 323 applies and when an investment can behave like common stock, even if the legal label says something else. Now we finally open the accounting engine. This video is about the core journal entries: the purchase entry, income pickup, dividend treatment, carrying amount reconciliation, and presentation. Think of this as the basic operating system of the equity method. Later videos will add basis differences, intra entity profit, losses, and impairment. But today we build the clean foundation first. The equity method is often called one line consolidation, and that phrase is very useful. The investor does not bring every investee asset, liability, revenue, and expense into its own financial statements. That would be consolidation, not equity method. Instead, the investor reports one investment line on the balance sheet and usually one equity income line on the income statement. The economics are deeper than a passive investment, but the presentation is still not line by line consolidation. So remember the idea: one investment line, but that one line carries a lot of accounting meaning. The basic equity method flow is beautifully simple before the advanced adjustments arrive. Start with the cost of the investment. Add the investor's share of the investee's income. Subtract dividends received. The result is the ending carrying amount of the investment. This is the flow we will use again and again. Income increases the investment account because the investee has earned value. Dividends reduce the investment account because value has been distributed back to the investor. It is not complicated yet. And that is good news because accounting gives us enough complications later without needing to invite them early. At acquisition, the investor records the equity method investment at cost. The basic entry is debit investment in investee and credit cash, or credit consideration payable if the purchase has not been paid immediately in cash. This entry creates a non current investment asset. There is normally no income statement effect at the purchase date. The investor has simply exchanged one asset, cash or other consideration, for another asset, the equity method investment. This cost becomes the starting point for all later equity method accounting. So the starting number must be correct and well documented. After acquisition, the investor recognizes its proportionate share of the investee's net income. The formula is straightforward: investee net income times the investor's ownership percentage. The journal entry debits investment in investee and credits equity in investee income. This means the investor's income statement increases and the investment carrying amount increases by the same amount. That double movement is important. The investor is not receiving cash yet, but its share of investee earnings increases the economic value represented by the investment account. Now comes one of the most important equity method rules: dividend is not income. Under the equity method, the investor already recognized its share of the investee's income when the investee earned it. So, when cash dividends arrive later, recording dividend income would count the same earnings twice. The correct entry is debit cash and credit investment in investee. Cash goes up, the investment account goes down, and the income statement is not affected. Cash is always welcome, of course, but under the equity method, cash does not get to wear the income badge twice. The carrying amount formula is the backbone of this video. Beginning carrying amount plus share of investee income less dividends received equals ending carrying amount. In later videos, we will add more layers such as basis difference amortization, intra-entity profit elimination, losses, impairment, and other comprehensive income. But the basic roll forward remains the same idea. The investment account moves with the investor's share of investee economics. If you can reconcile this formula clearly, most equity method questions become much less intimidating. Let us now apply the rules using Meridian Foods and Harbor Snacks. On January 2nd, 2026, Meridian buys 40% of Harbor Snacks for $500,000 cash. There is no basis difference in this simple example, which keeps the focus on the core entries. During 2026, Harbor earns $120,000 of net income and pays $30,000 of dividends to all shareholders. Our job is to record the initial investment, record Meridian's share of income, record the dividend received, and reconcile the ending carrying amount. This is a clean baseline example before the heavier topics arrive. For the initial investment entry, Meridian records the purchase at cost. The cost is $500,000 cash paid on the acquisition date. The entry is debit investment in Harbor Snacks for $500,000 and credit cash for $500,000. The economic effect is simple. Meridian now has an investment asset and cash has decreased. There is no income statement effect at the purchase date. This is important because buying the investment does not create income. It only establishes the starting carrying amount for equity method accounting. Next, Meridian records its share of Harbor's 2026 earnings. Harbor earns $120,000 and Meridian owns 40%. So the income pickup is $120,000 times 40%, which equals $48,000. The journal entry is debit investment in Harbor Snacks for $48,000 and credit equity in earnings of Harbor Snacks for $48,000. This increases Meridian's income statement and also increases the investment carrying amount. One amount, two effects. Income goes up and the investment account goes up. Now, Meridian records the dividend received. Harbor paid $30,000 of total dividends and Meridian owns 40%. So, Meridian receives $12,000. The entry is debit cash for $12,000 and credit investment in Harbor Snacks for $12,000. The income statement is not affected. This is the part many learners miss because cash received feels like income. But under the equity method, the income was already recognized through the $48,000 income pickup. The dividend is a distribution from the investment, not a fresh earning event. Now we reconcile the investment account. Meridian began with the initial investment of $500,000. It adds $48,000 for its share of Harbor's income. It subtracts $12,000 for dividends received. The ending carrying amount is $536,000. The check is 500,000 plus 48,000 minus 12,000 equals 536,000. This reconciliation is not optional decoration. It is the accounting compass. If the entries are correct, the roll forward should agree. If the roll forward does not agree, the journal entries need another look. This basic example also ties directly to Harbor's net assets. Harbor began with book equity of $1,250,000. It earned $120,000 and paid $30,000 of dividends. So ending equity is $1,340,000. Meridian owns 40% and $1,340,000 times 40% equals $536,000. That matches Meridian's investment carrying amount exactly. This happens because we assume no basis difference. In simple cases, the investor's carrying amount equals its proportionate share of investee book equity. Later, basis differences will explain why this equality often breaks in real transactions. On the income statement, the investor's share of investee earnings is normally shown as a separate line item, often within continuing operations and before income taxes. For Meridian, that separate line is equity in earnings of Harbor Snacks for $48,000. Notice what does not happen. Harbor's sales are not added to Meridian's revenue, and Harbor's expenses are not mixed into Meridian's operating expenses. That would look like consolidation. Under the equity method, Meridian reports its share of Harbor's earnings as a distinct line, preserving the one line consolidation idea. On the balance sheet, the equity method investment is usually presented as a non current investment asset. For Meridian, after all 2026 entries, the investment in Harbor Snacks is reported at $536,000. That amount reflects the original $500,000 cost plus the $48,000 income pickup, less the $12,000 dividend received. This is why reconciliation is so useful. The balance sheet amount is not just a number sitting there looking professional. It tells the story of acquisition cost, earnings recognized, and cash distributions received. Sometimes the investor and investee have different fiscal year ends. In that case, the investor may use the most recent available investee financial statements to record its equity method income pickup. This is called a reporting lag. For example, if the investee closes on September 30th and the investor closes on December 31st, the investor may use the latest available investee statements subject to the required consistency and disclosure considerations. The key is that the lag should be handled consistently. A reporting lag is a practical solution, not a convenient timing game. Consistency over time is critical. The same reporting lag should be applied from period to period so the investor's equity method income is comparable. If the investor casually changes the lag, it could shift income between periods and reduce comparability. If the lag is changed to reduce or eliminate the difference, an accounting policy change analysis may be required under ASC 250. So the message is simple: do not move the reporting lag around casually. Accounting likes consistency. It is not a fan of surprise calendar gymnastics. Now we briefly touch a special situation: share based awards. Sometimes an investor grants share based payment awards under ASC 718 to employees or non employees who provide services to an equity method investee. The accounting depends on the structure of the grant, whether other investors fund proportionately, and whether the granting investor's ownership percentage or claim on investee book value changes. This is not the main engine of equity method accounting, but it is important enough to recognize because these arrangements can affect compensation cost and the investment account analysis. The share based award issue becomes most important in a specific fact pattern. First, the other investors do not fund the award proportionately. Second, the granting investor does not receive a larger ownership percentage in exchange for the grant. Third, the grant was not part of the original acquisition terms for the investee interest. When those conditions are present, we need to analyze whether the granting investor has increased its claim on the investee's book value. If not, the accounting usually points toward compensation cost recognition rather than increasing the investment carrying amount. If the granting investor's claim on the investee's book value is not increased, the investor recognizes compensation cost in its own financial statements, timed to when the investee recognizes the related cost under ASC 718. The investment account does not increase simply because the investor issued awards. A side effect can arise for other investors. If their proportionate share of investee book value increases because they did not fund the grant, they may recognize income in their own equity method accounting. This is a reminder that equity method accounting can be relationship based, but it is still very much double entry based. This mini trap is one of the most common mistakes. Cash arrives from the investee and the learner credits dividend income. It feels natural, but under the equity method, it is wrong. The correct entry is debit cash and credit investment in investee. In our example, that is $12,000. The wrong entry would put $12,000 into dividend income and overstate income because Meridian already recognized its share of Harbor's earnings. The memory line is excellent: income first, dividend later, never count twice. The dividend is cash distribution, not a second serving of earnings. The financial statement effect map pulls everything together. The purchase entry increases the investment asset and decreases cash with no income statement effect. The income pickup increases the investment asset and increases equity income. The dividend receipt increases cash and decreases the investment asset, again with no income statement effect. At year end, Meridian reports a non current investment of $536,000 and equity income of $48,000. This map is very useful in review work because it tells you exactly where each entry should land. Before moving into advanced adjustments, make sure the core engine is clear. Start the investment at cost, add the investor's share of investee income, subtract dividends received, reconcile the ending carrying amount, present equity income separately. That is the basic model. Even when later topics add basis differences, intra entity profit eliminations, losses, and impairment, this core engine remains underneath. The equity method follows investee economics through the investment account. Income in, dividends out. Simple phrase, powerful memory hook. What gets adjusted later? The core engine is only the base layer. In video 4, we will look at basis differences, where the purchase price differs from the investor's share of investee book value. After that, we will cover intra entity profit elimination, capital transactions, other comprehensive income, losses, suspended losses, and impairment. Each of those topics modifies either the income pickup, the investment carrying amount, or both. So do not worry if today's formula looks too clean for real life. It is supposed to be clean first. We add the real world mess in a controlled way. In the next video, we study basis differences and equity method goodwill. This is where we ask why the price paid often differs from the investor's share of investee book value, how that difference is allocated to identifiable assets and liabilities, and how amortization affects future equity method income. If this video helped the journal entries finally feel logical, please like the video, subscribe to Commerce Regiment, support the channel, and share it with classmates, colleagues, and anyone who has ever wondered why dividends are not income under the equity method. I will see you in ASC 323 video 4, where purchase price differences enter the story.